Hey everybody, I'm Logan Alec. I'm a CPA, and today I'm going to walk you through how to input stocks from Form 1099-B from your stockbroker on your tax return. And then I'm going to talk about how long-term capital gains are taxed versus how short-term capital gains are taxed. And hopefully by the end of this, you see just how advantageous long-term capital gains can be for the average American taxpayer. Okay, so to do this, I have a couple things. I have my own 2024 basically broker statement, year-end 1099 package from M1 Finance, which is one of the brokers that I use. I do have a referral link to them in the description below if you'd like to check that out. Let me get my face up here though. Not that it's anything special, but I know when I watch videos, I like to, even if it's a screen video, I like to see the person. So we're going to look at my own stuff from M1 Finance from 2024, but we're also going to look at this kind of fake taxpayers, John and Mary taxpayer, in the professional tax software we use here at Choice Tax Relief. So right now, the only thing I've put on their tax return is basically $100,000 of W-2 income. Okay, I've assumed that both of them make 50 grand a year, and lo and behold, if that was the only thing they had, I assumed they were exactly properly withheld. Right, so a married couple, married filing jointly, making exactly 100 grand a year. For 2024, they're going to get the 29,200 standard deduction, a taxable income of 70,800. On that, they're going to owe $8,035 of federal income tax, and I'm going to assume they got exactly that much withheld, so they would owe nothing if this was their only income for the year and they were properly withheld. Oh, but wait. Let's say John and Mary were investing in the stock market in 2024, and they got this statement here you see on the left-hand side. Now, I'm going to ignore the dividends, not to say you should, okay? You should input all this stuff, and I've covered how to input all this stuff on other videos, like a link to my Robinhood one, link at the top of the screen. I went through all the lines that you'd get from your broker and how to input them. So check that out, link at the top of the screen. So I'm going to ignore the dividends, the 198 dividends, the substitute payments in lieu of dividends or interest. Not to say you should on your return, but just for purposes of this, you should input that. But just for purposes of this video, I want to focus on the actual capital gains here, okay, which we can see on the next page. They've kind of broken it down into short-term, and all brokers will do this. They break it down to short-term and long-term, kind of in summary here, short-term capital gains, long-term capital gains. And then if you scroll down, it gives you the details of, what you actually sold. Now, I love VTI. This is not investment advice, but I love the Vanguard Total Stock Market Index Fund. I'm not big on picking individual stocks. I just like to dump money into the index funds, the Total Stock Market Index Fund, and that's how I operate. If you watch some other of my investing videos, that's how I operate. Now, you can, okay, so first part of this video, how do you report this stuff on your tax return? Okay, I'm going to make it super easy for you. You don't need to report each one of the transactions one by one. Okay, this is what I would do. And I don't even have that many here, right? I mean, some people, these 1099-Bs, they're dozens and dozens, sometimes even hundreds of pages. What I'll do here is I'll simply input. I'm going to make literally just two inputs here for the capital gains. I'm gonna input the short term in the aggregate, and then the long term in the aggregate. That's it. I'm just gonna call the description, M1 Finance, short term. Okay. And you can see here it says covered tax loss. If it's covered, that means the basis was reported to the IRS. And so for short term, that's box A on the A949. For long term, that's box D. So I'm going to tell my tax software, yeah, basis was reported to the IRS. For the date acquired, I'm just going to maybe say, sometime in 2024 because it's short term. The date disposed sometime in 2024 because it's short term. The proceeds, I'm just going to put 5,008 here to round up. And my basis, I'm going to put 4,402 to round up again. Okay, and then I'm just going to, and I have no wash sales disallowed there. Long term, I'm gonna do the exact same thing, right? I'm gonna call this M1 Finance Long Term, and it was all covered, meaning the basis was reported to the IRS. So I'm gonna say basis report to the IRS, and because it's long term, I'm just gonna put a date, before 2024, whatever, so that it's at least more than a year and a day. Proceeds, I'm just gonna put the 501,857 there. The cost or other basis, 375,288. Boom. Okay. So now let's see how this approximately $127,000 of capital gain, the vast majority of which is long-term, affects John and Mary's tax return. So how much did what they owe go up? Wow, they owe another $15,661 on this gain. And so what's kind of the essentially the effective tax rate there, right? Doing some quick math over here, it's about 12.3% is the effective tax rate on that. Okay. Now I'm going to erase these capital gains from the software, and I'm going to show you, okay, what if instead of having $127,000 of long-term capital gain, they had another $127,000 of, let's say, business income, right? Let's say they start a small business and they make another $127,000. Let's see what happens. Okay, so check this out over here. So 100,000 wages. Instead of having another $127,000 of capital gain, I've assumed they have another $127,000 of business income. Let's say John, he netted. I would, if this was an actual Schedule C, we'd actually put the gross receipts here and all these expenses down here, but I'm just showing you math here, not how to do a Schedule C. I do a video on how to do a Schedule C, link to that video at the top of the screen. But, I just want to say, hey, John netted 60 grand his business, Mary netted 67 grand. Okay, so instead of $127,000 of capital gains now, most of which were long-term, they netted another $127,000 in their business. Okay, how does that affect their bottom line? And they get the QBI deduction for it, right? How does that affect their bottom line or what they owe? On that $127,000 of business income, they owe $36,000, $36,365, right? So let's see the effective tax rate there. Wow, 28.6%. As opposed to if they have another $127,000 of capital gains, most of which are long-term, they're only paying an effective rate of 12.3% on them, right? That's huge. That's another $20,000, going from $15,000 to $36,000. That's another $20,000 in taxes that they're paying, even though it's the same amount of increase in income, right? $127,000, but because it's a small business, right? They don't get the preferential long-term capital gains rates, and they have to pay self-employment tax, right? As opposed to the capital gains, they're only having to pay, capital gains rates. So what are these capital gains rates? Let's talk about it. But first, let me get rid of the Schedule C inputs here. So we're back to kind of square one, because I want to show you something that I think you really think is really cool. Okay, so we're back. We're back at square one here, right? $100,000 W-2 between the two of them. No tax due because they're completely properly withheld. So check this out. So here's how the long-term capital gains brackets work. Okay, this is for single. This is for head of household, but we're talking about a married couple here. So this is for married individuals filing joint returns. So you're in the 0% long. Well, first of all, short-term. Well, okay, let's talk about long-term first. You pay 0 federal income tax on your long-term capital gains all the way up to $94,050. This is not adjusted gross income. This is taxable income, folks. Okay. So what's their What's their taxable income right now? $70,800 right here. Okay, this is your taxable income. See line 15, taxable. That means that they could have another, let's say 23,000. Was that 23,000? I get this right. $23,250. That's the difference between $94,050 and their current taxable income of $70,800. They could have another $23,250 of long-term capital gains, and I don't have to pay any more tax. Watch. I'm just gonna say, long-term capital gain, whatever. They bought it last year. They sold it this year, and let's just say, what was my number? Was it 23,250, right? So let's just 250, right? And say it's long term. Okay. Let's look at the return. Okay. All right. So they got another $23,250 there. That's long-term capital gains. Boom. They owe no more money than if they didn't have that capital gain. Isn't that wonderful? Isn't that beautiful? Right? So if you're not convinced to start investing now, and I'm not a financial advisor, I'm not going to tell you what to invest in. I've shared with you earlier in the video what I like to invest in. But that's, that's the power of investing. It's not just great because you grow your money over time, but because in our system, we have these long-term capital gains rates that will reward you, right? And especially if you, are a hardworking American, hardworking middle-class American, like, these folks, they each bring home 50 grand a year, right? They're rewarded for investing, right? Because the government says, look, even though you guys made, and this is a six-figure household income between the two of them, right? Even though you made a solid household income between the two of you, we're still going to say, hey, you could get another $23,000 of long-term capital gain and not have to pay any more federal income tax on it. Isn't that incredible? Now, it's not the same with short-term capital gains. Okay, so let's go in here. I'm gonna go back in the data entry, and let's say, just to make the numbers easy, let's say they had $10,000 of short-term capital gain. Okay, how's that going to affect them? Remember, they're starting at zero. They have their W-2 income. They've withheld exactly the right amount to the dollar. How much of a difference will short-term capital gain make for them? So check this out, right? So they're here. There's another $10,000, and it's short-term capital gain this time, right? They have to pay an additional $1,200. Why is that? Well, that's because you pay tax on your short-term capital gains at the same rate as your ordinary income, right? Same rate as your W-2 income. So, we look at this, for 2024, married folks filing jointly pay a 12% tax on taxable income from $23,201 to $94,300, right? And they're within that range, right? With or without the short-term capital gain, right? So the additional tax on $10,000 of short-term capital gain is $1,200, which is the 12% you see here. Okay, so what's kind of a takeaway here, folks? Well, one, when I talked about how to input your stock stuff on the return, just make it simple. You don't have to input every single line, every single transaction. You can just say, hey, this is M1 Finance or whatever, or Schwab or Vanguard or Fidelity or whatever, Robinhood, covered, right? Long-term or short-term covered, short-term uncovered, which means if it's covered, basis reported to the IRS. Uncovered is basis not reported to the IRS, and then long-term covered, long-term uncovered, right? And you can just put it all in the aggregate, right? And then, kind of when I was talking about more the tax rate thing, I hope this little example here kind of shows you the power of long-term capital gains, right? Because instead of having to, pay a portion of those gains to the government in income taxes, you can get them tax-free. I mean, up to a certain point, right? Obviously, kind of going back to this here, right? If, when they start, let's say that it was more, let's say it was, their taxable income, including the capital gain was more than this 94,050. Okay, then on some of their capital gains, they're going to pay 15%. Most of them they're going to pay 0% though, right? Or well, let's say it's like their new taxable income, including the long-term capital gains, is 100,000, right? Most of those, and you know, let's say it was $23,000 of long-term capital gains. Most of those long-term capital gains, they're still going to pay 0% on. A little bit, they're going to pay 15% on, right? And you know, let's say they make more than this, right? You know, from between here and here, they're still in that 15%, right? Long-term capital gains bracket, which is huge. You know, let's say you're married and your taxable income is including the capital gains is $500,000 a year, right? What tax bracket are you in? I mean, well, you know, a lot of it's in this 32% bracket. You know, some of it's in this 35% bracket, right? You know, but let's just say that the numbers matched up such that your taxable income without your long-term capital gains is $487,000. Okay. And then let's say you sell $13,000 of long-term capital gains, right? Well, instead of paying 35% on that, what are you paying? You're paying 15%, right? That's like less than half. And you don't even get to the 20% unless you're over, if you're married filing jointly for 2024, $583,750 in taxable income, right? It's huge. You know, and I think people know this, right? Oh, long-term capital gains, you pay a lower rate, right? Okay, we know that. But I just want to show an example here, kind of in my tax software, to show what this actually looks like on the return and how cool it looks on the return, right? And I might be betraying myself as a total tax nerd here for talking about how cool a tax return looks, but you know, that's the reality of it. All right, folks. I have some other videos here about reporting stocks in your return. Here's my how to report Robinhood stocks in your return. I go through all the forms you get from your broker in that one. It also applies to other brokers as well. And then down here, I have my video on the difference between qualified and non-qualified dividends, right? Because you'll see that on your 1099 package from your broker. You'll see your ordinary dividends and your qualified dividends. What's the difference there? Check out that video. Thanks so much for watching, everybody. Let me know any questions in the comments. I'll see you in the next video. Bye-bye.